broadcast is now starting. All attendees are in listen-only mode.
Hello, 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 hello. Right. We'll be waiting 2 more minutes, then we'll start off this webinar. A minute more, and then we'll start off this webinar. Right. Welcome and good evening, everyone. Welcome to our webinar, The Road for 2019 Market Outlook. And I welcome each and every one of you. Thank you for your such a precious time. Though I had to keep you on hold because I was trying to get as many people as they can fill in and we can start. So we are already running behind the time, but better late than never. So if you guys have, let me first put it this way, that you have a question box over accessible on the right hand side of this particular screen that you are viewing, and right. So you can put your questions there if you have any question that is related to your market or portfolio, and anything that is you think can be asked, you can put it down there. So our today's webinar is on the road for 2019 market outlook. Well, so what we'll be doing is, the agenda of this webinar is just to look at a few screen charts, screen reads, few charts, put some indicator out there, and then assess what the market is going to be. Because 2018 somewhat started off with a volatility, and still it continues to be a threat, with it being almost 185% up last 3 months. Talk about CBOE volatility VIX, and it does matter, measure the sentiment. So having that being elated at the end of the year, being up at the end of the year, is something which we are worried, and of course, as a trader investor, you should be. So how does this thing work out, and what are particularly charts that will be going to see are completely different case, because the chart which we are going to see will be of the indices, particular currency or so, but of course commodities as well. But we'll look at some important points that I should be showing you. So these are some of the awards and recognitions that we have had in our kitty for past few years, and this is our credibility and certifications and associations. So from here, right. So I was trying to make this particular slide, but then I have not finished it, because I would be like taking you to live charts, and I was trying to put it in the perspective that what are the things that will drive. So I've written like uh, here crude oil, corporate earnings, economic data. So what is it that we need to understand? What is different this time for the market? And so it's like empty. So spare my coughing. So these are some of the charts. I was trying to put that slide, and what are the factors that can be, because I couldn't have sum it up what are the things that is affecting. So when I thought about Singapore as a country, how can it be less of those big words like valuations or big technical analysis words, rather than what can we sum up in a chart. So I thought to keep it very simple, so that you would be able to see, and I hope I'm audible to each and everyone. If it does stop, you can just ping me here. So first and foremost important is US GDP chart, and this is since 2008. You might not want to look what was before. Before that, it was kind of enough, but this is a possibly self-speaking chart. You don't need to decipher it much, but just in case you want to look at it in a different perspective. Since 2008 financial crisis, so anywhere above 4, hope you can understand what I'm trying to say. That United States GDP anywhere above 4, right, has been a bit shaky. I mean, it shows a sign of fatigue, it shows a sign of topping out, and the valuations of the market become expensive, right? This is what the chart says. So, for example, if I'm talking about, sorry, talking about Yes. So this is like 2010. So this is 2000 somewhere post 11, 2012, 2014, and this is where actually it took time. That was due to, of course, easing out of QE, and uh, that is how it formed over here. But if you look at the chart, this is something major point that needs to be taken away. That above for US GDP shrinks, and how fast it shrinks? It shrinks quite fast. You look at this, the drop suddenly to two, towards zero, right? I hope that is simple enough for you to understand. Of course, it can move beyond 4, but in today's financial market, with global markets falling, crude oil at all-time low, we certainly cannot, think of something as bright as like U.S. economy or GDP going above 4 or towards 6. I mean, that would be too optimistic for now. But we are not optimistic in 2019. You must know that 2019 comes with a lot of challenges, specifically for the global markets. And this is since 2018. So you must understand that. Let me erase all the drawings. Yes. And you must understand that this is somewhere trade war that has begun. So when I talk about above 4, these are some clear. Now this is like US GDP growth rate, so it has a frequency of monthly and that quarterly thing to it. So when you look at it, you must understand the slow, or the shrink that we talk about comes in next 2-3 quarters. So what you can assume from this data, putting all things aside like PMI numbers or sales numbers or retail sales number or whatever, if I can give 10 of that, you must understand from one simple chart that around 4 or above 4, US economy has a kind of, you know, impact where it shrinks back to 2 or 2.5 or 1 in that matter, because you look at this, the kind of downfall from 4 levels is somewhat fast. So we may see an uptick going forward, but with like rates, Fed rates being up, and 2019 they also have like a target of increase by twice to 3% by the end of 2019. So this Federal Reserve pushing up its policy rate to above like 2%. 2% has been neutral for it. So just let me search for this. I'll just show you on the chart so you'll be able to understand. Sorry, it's actually very chilly here in I hope you are able to see. So this is 2.4 right now, and since they have been on a rise, so it was 2%, which was a bit neutral post 2009, 2008. We have seen that to be levels, but suddenly there was this upward rates, and we are on the same trajectory, but this is something different as of now. We cannot call it towards that kind of a trade what happened back in 2007, 2008. So with that, what we are trying to gauge from this particular point of slide is that one should be cautious on global markets. As soon as we have seen US GDP above 4, there can be some signs that sorry. Yes, uh, this is something which uh, s- foretells us that why SPX is down, or why we have seen that kind of a damage. Now, second and important one is charts you should see. So that is SG. Singapore's, it is since 2010 as well, 2009. Why I'm talking about 2008, 2009? Because I want each and everyone to know that the bottoms we have seen in financial markets in 2008, 2009 are out of extreme fear, panic, extreme panic that can be resulted in numbers. So if I read it correctly, that 2008, 2009 bottoms are the mother for a bullish market. They are like a kind of a very important base that our recent financial markets, if not way back recently, they have formed these bottoms in 2008. So whenever we talk about any kind of a correction, any kind of expansion, or any kind of sorry, valuation where prices can become cheap, we can gauge it to 2008 levels, but we may not get to similar levels. But 2008 is somewhat a benchmark in terms of fear or panic, extreme panic. So this is 2008, 2009, and that was the GDP you could have seen. And since then we have seen Singapore GDP. Now, if any one of you has been part of my this webinar, this is SG GDP, and you look at this. Let me just point out, and then so let me just pop it out, and you may be able to see it. Yes, so this is 2000, right, 2010, and this the above chart is of STI, so you'll be able to see what I'm talking about, right, 2010. So when I say how does it affect, or how you, I hope you are listening, because this is important. This one particular chart gives you kind of an understanding which you may be able to understand what I'm saying about why 2019 is a challenging year. Uh, so this is your SG GDP back in 2000, like 10. 2011. This is your STI as an index in 2010, 2011, and this is 2012. So we were seeing an expansion in 2000 over here, and that's what we have seen over here. This comes 2012 end and then 14, so you'll be able to see this is 12 end and minor correction, then again up. You see the kind of bottoms that we have made, and the market was higher, and then suddenly in 2015 we have seen a kind of a sudden drop. So this was when the financial markets in China collapsed, right? That 3 trillion suddenly, when everyone was crying aloud, and yes. So then again, bullish markets. So 2014, 2015, there was a kind of a bottom which we have seen, and from that some activity did pick up, and here in 2018 starting somewhere around 2017 end, and you can see it's similar over here that there was a kind of a top formation, and since then we have been down, and so this is what one can relate to. These are like, I can put it in a sync way, I can show you in that particular way, but I think right, you'll be able to understand that Singapore has been within this post-financial crisis, right? But good thing is that what it differs to, suddenly, Mr. Sharma, why Singapore is. So when you talk about US, it's on the higher side of its expansion phase, right? So we might see a quarter or two more. This can go up like this, and we may see somewhere 4.2, 4.3, 4.5, somewhere that, and then we can see a slide. And on the other side, we are seeing somewhat Singapore on the lower part of this particular range, which has been there for almost 10 years now. There is nothing subjective to it. It's purely objective that we have been in a range that is around 10 to 0, right? It dipped minus below 0, but it was fast enough to recover, like over here, suddenly recovered to grow 40. Then over here, growth rate recovered to 10. So somewhere GDP growth rate is between 10 to 0. Now, let me show you the chart, and I hope you can see this particular screen and the charts. No, not this. Right. So I think my few lines are already there, and sorry, spare me. So this is since 2009 and pretty much same from what you see over here. Here, this one. So you see the kind of movement, very ranged down between 2015, 2014 and 2016, somewhere in 2015, then again up. So how many times we have seen it below zero? That is one, 2012, right? This was very quick and able to recover from that. Then around 2015, so 2012, right? Uh, 2015, okay? Any doubt? No. This is 2015, this is 2012, somewhere in 2000, late 2012. Then this is 2017 and somewhere around early 2017. Oh, sorry, late 2017. And then this bottom, sorry, this top somewhere on the early 2018 or in around 2018. So we'll see how our market is going. And so yes, over here 2012, right, when we have seen a bottom in GDP data somewhere in 2015, somewhere in 2015, and then it dipped below zero back in 2017, but early 2018 we have seen a top formation. So if you look at this chart, it looks similar to your GDP. As simple as that. Let's not mix the words. Am I clear? This is where the demand is, right? Because I mean, let's face it. Sorry. Here you go. Uh, Now you'll be able to understand. Okay. So let's take it from 2010 here and delete all the drawings. There you go. So you want me to add a line to it, and I'll do it. Here, that's a zero. So somewhere in 2016 September. This is somewhere in 2015, 2013, and since then we have been seeing this was a final top in September 2018. So let's look at our Straits Times Index, and this is what it has been as well. There is no difference in the chart, right? So that's the same chart like GDP of quarterly data. So what I'm trying to say is that we have a certain demand and supply zones that are already in place in Singapore and as a market. Then we'll talk about KLSE as well, of course. but SG leads us, so that's why I'm drawing it on SG, and this is somewhere between that the demand should come. Now, this is what a very good long-term bottom is. The only support for now the market has is this particular line that is standing from 2009. Right. Uh, that is drawn from 2009. So that is what giving support to prices of SGX. Right now, if I do it like this and readjust this to, so that is what giving support to prices. So if someone is looking to do a directional short term trade, of course, as far as we are about 2970, 2950, SGX can go back to 3300, 30, 250 levels, and this may be a short term bounce back because we have been in a downward momentum. So of course from here, short term bounce back to 32, 50, 32, 30 cannot be ruled out, but we are still in a kind of a bearish momentum. So if we go below 3000 anytime on a closing basis, we are going to see somewhere between 2650 to 2700, where we may see some kind of a bottom. This is in view that we may see in second quarter or third quarter of 2019, not first quarter, because we still believe that correction in global markets may continue. The damage has been done, and that is what is going to be reflected in across the Asian markets. Now, having said that, other thing that you need to look at is China as a market, and one of the main countries, and very important to Singapore as it's one of the markets where it's exporting its most of the uh, uh, for Singapore. So a lot of things depends on this. There can be like rate hikes in the US, but that is being discounted in terms of prices. But there are some good trade agreements that actually Singapore as a country enjoys with uh, both US and China. So I think that is one thing that can be looked at. But only thing that we have is of concern is Fed hikes this year, and it should not be more than one or two this year, at least in 2019. We don't know because 2018 has been on a surprise. They were on a path, and they have done it quite systematically with every data in their favor. So that is one thing of a concern. But what for Singapore or Asian markets is that earnings and how things may be for specifically sectors such as financials, which has outperformed in sorry, uh, 2014, 15, 16, stocks like DBS or Syntech or like Public Bank in Malaysia. So how these stocks behave, and how these stocks go. That is important because from here the growth rate, if you see, we may see some kind of a dip over here. We may see a kind of a shrinkage or downward move in US GDP, and China is on a continuous downward move despite the fact that 6 as a growth rate is its important number since 2000. We have seen that to be active. It was around 16 as well before 2000. Then we have seen a growth rate stopping at 6.5, 6.7 odd levels, then going back to 14 levels and coming back. So we may see some investment activity being picked up here around 6. That may turn out to be good for uh, Asia as an economy, but it all comes down to you know maybe panic and fear, because I believe that there has to be enough amount of panic in the market to give us a very good long bottom in a place that can give us a very good bullish market. So if I then come back to charts and let me show you one by one so we can. So this is STI, and I'll give you what as simple as that. This is a weekly chart, and this is a kind of a linear regression line that I have drawn on this from this point of time to somewhere from here, and that has been the overall trading range. So when we talk about STI, um, 2800 to 36 and specifically 3400 will be the range for 2019. So if you see any kind of correction in market around 2800, you should be a buyer in specifically SGX, and that is how uh, we find things with KLSE as well. Uh, let's put it on a weekly chart. For now, prices are at a very good support of 1630, 1640 in Bursa, Malaysia, and if anyone is looking to go for value, like uh, buying at some lower levels which gives a lot of value, of course I think can be done statistically, because we are at the lower part of a trading range. So somewhere around 1640, 1630, we may see a kind of a revert in index. Um, And what's working like in Singapore, we have a trend line. So this is somewhat working out for Malaysia. So you must keep a close eye on 1650 or 1640 levels. That can be a game changer for KLSE. So if we are above like 1703, we should have no problem for markets going back to 1800 levels. So above 1703, one can look at a directional play in index like KLCI, maybe March or February, or like later contracts for higher targets of maybe 1800. Important to look at is HSI, which is one of the most important index because that is what keeps track on other Asian markets. So HSI, that is okay. That is HSI for you, and it's still a bit far away from 24,300, but you must understand that this is a double top kind of a formation over here. You see these two tops; those are very important, and then initial run up. It took almost like 10 years for market to come up, or like from 2017 2016, for 2 years it took time to come up. It's just 1 year we have covered more than 50% of the gains of last 2 years. So of course we have seen corrections in the past. We have seen corrections. Trade war has been one of the spoiled things for equity markets. But this is something not, again, I want to tell that we have seen in 2008, because 2008 was clearly a financial crisis based on uh, leveraged derivatives products like MBS, and uh, the outcome was actually this bear market, which was totally like panic over here. But recent correction in the market have been systematic, and they come with a volatility, but they do come. So what we have witnessed here is volatility. So somewhere around 23,000, 23,500, SGX, sorry, HSI as a market should see some kind of bottom, because this is not something which everyone needs to worry about, because that's how market works. 2008, 2007 was a different thing, but this is more of a systematic correction. So one should not be aggressive. One should wait for HSI to come around like 24,500 or below 24,000 level for these extreme bottoms when prices are most favorable. I always tell that you need to wait for markets to make a like a top or a bottom which is most favorable, which is uh, outcome of a lot of sentiments coming together. So that is for SGX, KLSE, and HSI. Let me be very specific that we believe that few commodities may perform well, and few commodities like gold as a commodity. We are a bit bullish on, because this may perform well in coming years, because given the rise in volatility, given all the things related to equity market and downturn in dollar index, we expect gold to perform well in 2018, sorry, 2019, 2020. On an upside, we might see this particular rally, to maybe 1350, so that is still like $40-50. So anything that has to do with like maybe gold ETF or jewelry or gold stocks, I think those should be kept on an uh, radar. Once we are above this level, that is 1360 on the gold, a lot. I mean, the upside is it will be very fierce and fast. But I'm not expecting that for now. But yes, on a conservative side, if anyone is like into comics or commodities, he should or she should be looking at gold for 1340, 1350 levels. So that is in gold. We'll look at other commodity and what is that? Some analysis, I think. So this is crude oil. I think the broader range for crude oil continues to be this. And why? Because if you look at it, I mean, one, two, three, four, five, almost 5 quarters of uptrend. That is like 15 months. 15 months of uptrend, and only it all took like what? 1 year. I mean, 12 months, and such a bearish market since like last 3 or 4 months. I mean, so that's the range for crude for coming 1 year. I think there can be a short-term bounce back in crude given this double bottom formation, and around 43 there is a very strong bottom in crude oil, and we may see some an uptrend to 52 and 54. We might also see an expansion of this particular rally to 58, but that's the range for crude oil, and we believe that it has to be between 42 to 60 or 73. But yes, buy low, sell high. That's how things may work out for crude oil. So if you have any questions, I think I might ask you, because we are a bit close to our time. If you have any particular positions that you need to know about, you can ask your questions. I'll be happy to answer, and then we can call it a weekend. While with that, I'll then with that I'll show you Euro USD, I guess, as a currency. Oh shit. Sorry. We are going to weekly or monthly data, so we can remove the noise from the charts. Yes. See, I think the trend lines are already in place. Nothing to tell for now, at least. The only thing we have is one an upside, right? Honestly, I we suggested clients to short somewhere around 1.25, 1.24, and this is kind of a bottom W formation where it went up, but still we believe that the overall trend is between these channels. So for now, let's get back to our regression and see what the trend is. So it will be between 1.20 to 1.12 for Euro USD in 2019. There is not much major move which we have seen in 2017 or 18, because usually these are trending periods of Euro USD or currencies. They do come, but they come like for a very specific amount of time. For example, right. So like this particular, there was a brief consolidation, then a trend, then a trend. This, but we are going to see some kind of consolidation now. There may not be a trend in 2019. The continuation may be seen, but specific breakouts may not be seen. That is 2SD, and this is monthly chart. Yes, so 1.10 to 1.18 and maximum 2 for now. Uh, Trend for Euro USD may only be reversed upon 1.19, while a breach of 1. Maybe 1200, we may see a bearish continuation in Euro USD to 0.95, 0.9. That is to lower part of this channel. Though what differentiates this particular move from previous ones are the kind of velocity we have seen. That was pretty much one-sided. Sorry, pretty much one-sided. So if we look at this particular movement in 2018, 2019, I think one would be able to understand that it has not been that fierce. I mean, you look at this movement, look at this, the kind of fall we have seen in prices. Sorry. So, from my perspective, we can say that the trend for Euro USD is currently sideways because the rate of change is not that high. So I think I'm getting few questions. If you have any questions, you can put it down, and I'll be happy to answer. Then we can wind up this webinar. And So those were the three charts of GDP, and this is about us, Epic Research, and those are some of the signals we provide into various markets, be it SG, MY, HSI, or uh, currencies, COMEX. So I'll be just waiting for your questions. I'll be surely reaching back to you. You can reach back to Epic at info@epicresearch.sg or epicresearch.my, and your query or any particular suggestions you have, I'll be happy to note it. Yes, Wilson, that's what I think we have discussed in previous webinar. But since you have asked that, I'll be courteous to you and show you. I think I have the presentation as well, previous presentation. So let me just draw your attention to this chart for a moment while I open that for Wilson. And which sectors are important in 2019? See, I think if someone was there in previous webinar, we said that 2019 may see a kind of a bottom for so markets like SGX or KLSE. Uh, how or when we were not able to answer it, but yes, we thought of as maybe in quarter two or maybe around. So this is yes, I'm coming back to you. Just a sec. So that is this review of 2018, and which sectors, like Wilson asked, genuine question that which sectors, of course, which sectors actually perform well. So one of the thumb rule that goes with market for me specifically is that sorry, um, previous leaders shouldn't be bought. Previous leaders are somewhat becomes the laggard. But what I have particularly favored is one, ST Engineering, two, Singapore Technologies, electronics, of course, and aerospace, and apart from that, let me show you these two charts, Wilson. You'll be happy to see that this is financials, of course, leading. That was small, large cap and mid cap, and this is relative return. So if I'm talking about if I'm not able to invest in SG, what, and this is sector wise return. So of course financials followed by consumer service followed by st china index. So any particular index or stock that has exposure to maybe china or export oriented or any particular stock, that sector like consumer service and of course financial. And then we have had industrials and other uh, sector. But what I believed is that specifically like Singapore Technologies is good. ST Engineering from aerospace is also good. And if you want to go for like earnings visibility where you are seeing some kind of uh, earnings, I think just a sec. I think if I'm right. From financials, one can look at DBS. There is no doubt about it. Everyone has uh, taste or flavor for Comfort Deligro is something which I believe is showing a good chances of reversals in the long term. So I think if anyone is looking to invest in uh, long term for in 2019, I think Comfort Deligro around 2 1.95 is good. As I said, Rama Rao, and your point is also noted for Bursa Malaysia and the signal. Uh, how the market for 2019 Bursa Malaysia is. Of course, as I said, KLSE follows what SGX, because that is the butter or bread and butter of Asia, and KLSE, if you can look at the chart, I'll show you. One should be invested in. Yes, one should be invested in KLAC around 1600. There is no doubt about it, because it's in relative terms much better as compared to SG as a chart, because the returns we have seen are much better. While SG has been in a consolidation, Bursa has been on an expansion for a prolonged period, though it has seen a double top formation. So as far as above 1600, there is no problem. Only problem come is below 1600. But as I said, if someone wants to trade a directional above 1702, we believe that KLCI should test 1830. So if one is a derivatives or futures trader, I would particularly be long in KLCI, maybe March or April contract. Around those levels of 1610, 1620. So I think that is it for now. We have covered our most of the slides and most of the questions as well, I think. But if you are still wanting to ask, you can reach me at L as in Lovelace, and right, so it's like L Sharma at the rate epicresearch.sg. L Sharma at the rate epicresearch.sg. I'll be happy to help, and with that I'll be ending this webinar. Hope all of you are going to have a great weekend, and God bless. Thank you. Please do reach me any way you can, and you can drop in your questions. I'll assist you. Thank you. Bye bye.